A $2.3 billion loss is putting Mandalay Bay on the brink. What's killing this legendary Vegas resort hints at a disaster creeping up on the whole strip. Built for nearly $1 billion, with another $1.6 billion sunk into renovations, Mandalay Bay now stands half empty as formerly loyal guests drift away. But this unraveling began before pandemic slumps or tragic headlines. The real story is how relentless resort fees, luxury cutbacks, and shattered trust have driven high rollers and families alike to abandon the property. What happens when the Vegas dream itself no longer delivers? And could Mandalay Bay just be the first to fall? Las Vegas once thrived on an endless stream of visitors, millions pouring in each year for conventions, concerts, and the promise of luxury weekends. But by late 2024, the crowds had thinned. Citywide visitor numbers fell sharply, with official data showing an 8 to 10% drop year over year. That may sound modest, but in a city where every percentage point represents tens of thousands of empty rooms, the impact was immediate and brutal. At Mandalay Bay, the reality hit harder than anywhere else. Once packed with business travelers and vacationers, the resort's cavernous lobbies and sprawling convention halls began to echo with emptiness. Analysts tracking foot traffic noted that weekday occupancy, once reliably above 90%, slipped below the critical 70% mark after the disappointing 2024 Grand Prix event. That threshold was not just a symbolic line, it was the difference between profit and loss for a property built to run at near full capacity. The numbers told a story of mounting urgency. MGM Resorts, Mandalay Bay's parent company, reported a 7% drop in Las Vegas revenue in the third quarter of 2025, the fourth straight quarter of decline. Room revenue alone shrank by 11% compared to the previous year, as both leisure and business travelers chose other destinations or stayed home entirely. Convention business, once the resort's crown jewel, withered as companies slashed travel budgets and remote work became the norm. Brokers tracked dozens of major group cancellations and non-renewals, draining the steady flow of high-spend guests that once kept Mandalay Bay's towers full. The collapse was not unique to this one property. Across the Strip, gaming revenue dropped by 5.5% in September 2025, the first time in years the house did not win. But Mandalay Bay, with its massive footprint and sky-high fixed costs, was especially exposed. Even as staffing was cut and amenities scaled back, expenses like debt service, utilities, and maintenance barely budged. Every empty room and canceled event sent the bottom line deeper into the red. Inside executive offices, the mood shifted from confidence to alarm. Reports showed not just fewer guests, but guests spending less. Restaurants sat half full on weekends. High roller suites went unbooked. The old Vegas certainty that if you built it, they would come, no longer held. For the first time, Mandalay Bay's leadership faced the possibility that no amount of investment could fill the void left by a vanished crowd. The search for new revenue streams began in earnest, setting the stage for decisions that would upend the guest experience and spark a backlash felt far beyond the casino floor. Inside Mandalay Bay's accounting ledgers, the problem was clear. Revenue was falling, but costs barely moved. Unlike smaller hotels that could shutter floors or cut hours, mega resorts like Mandalay Bay are chained to a cost structure that barely flexes when business slows. Debt payments, insurance premiums, utilities, and maintenance for thousands of rooms and acres of public space stay fixed, whether the towers are packed or nearly empty. Payroll shrinks at the margins, with housekeepers and dealers sent home early, and some restaurants closed on weekdays, but the core expenses remain relentless. Industry analysts estimate that more than 70% of costs at a property like Mandalay Bay are fixed. That means when room revenue drops by just 10%, profit margins do not just shrink, they collapse. A bond analyst put it bluntly: you can pour $1 billion into gold-plating the doorknobs, but if guests feel ripped off, they just leave, and now they are. The numbers tell the rest. In September 2025, gaming revenue across the Strip fell by 5.5%, the sharpest decline since the pandemic. Citywide, visitor spending was down, but for Mandalay Bay, the pain was sharper because the property had to fill more rooms and sell more expensive experiences just to break even. When occupancy slipped below 70%, the resort's entire business model buckled. Every empty suite or canceled convention meant lost income that could never be offset by trimming a few shifts or closing a pool early. Executive reports circulated with a new sense of urgency. The old playbook of raising rates, adding fees, and cutting perks was not working. Instead, each attempt to squeeze more from guests seemed to drive more of them away. As one consultant warned in a confidential memo, the math no longer supports the scale of investment. For every dollar spent improving the property, less is coming back in return. The gap between capital invested and revenue generated has grown so wide that the possibility of bankruptcy, once unthinkable for a South Strip icon, is now a real risk. The ripple effect reached beyond Mandalay Bay. Across the Strip, luxury resorts built for high-volume events and premium guests face the same squeeze. The fixed costs of Vegas, towering debt, relentless upkeep, and a labor force stretched thin became a trap. In executive suites and boardrooms, panic set in. If Mandalay Bay, with its billion-dollar renovations and storied brand, could not make the numbers work, what hope did anyone else have? The search for new revenue became desperate, setting off a wave of pricing experiments and service changes that would soon upend the guest experience for everyone. In 2015, Mandalay Bay quietly raised its nightly resort fee to $45, joining other Strip hotels that hoped guests would accept the extra charge. The fee was attached to every booking, promising Wi-Fi, gym access, and local calls, amenities that often went unused or unnoticed. Instead of boosting revenue without fuss, the move triggered a wave of anger. Complaint logs filled up within months. Guest satisfaction, once a point of pride, fell sharply from 82 to 68 in 3 years. Social media erupted. Hashtags like #MandalayBayFee spread as travelers posted bills and vented about feeling misled. On TripAdvisor reviews, calling the fee a deal breaker jumped by 1/3. 1-star and 2-star ratings surged on Google and Yelp. Maria Lopez, a housekeeper for 5 years, remembers the fallout. She found notes left in rooms, some furious, others resigned. A guest scrawled on the bathroom mirror the words, "Never again." Lopez says that after the fee went up, people blamed staff. Guests would ask, "Why am I paying for this?" She says she wanted to help, but there was nothing she could do. Staff across the hotel, housekeeping, front desk, and restaurant servers were left apologizing for a decision they never made. The fee became more than a nuisance. It signaled a breach of trust. Convention planners, once loyal to Mandalay Bay, started looking elsewhere. Michael Chen, a senior planner, pulled his association's 2025 meeting after the resort raised fees and cut group perks. He says he had to explain to his board why they would pay more for less. He moved the meeting across the street, and he knows a dozen planners who did the same. The data told the same story. Between 2015 and 2018, complaints about hidden fees at Mandalay Bay rose 187%. The Nevada Attorney General's office logged hundreds of grievances. The Better Business Bureau flagged the resort for poor complaint resolution. Still, the $45 fee remained in place even as occupancy and loyalty dropped. Analysts noted that Mandalay Bay's push for more revenue only sped up the loss of guests. A hospitality professor said the fee was a short-term fix for long-term problems. It destroyed the value equation. A simple line on the bill had snowballed into a reputational crisis. Mandalay Bay, once seen as a luxury escape, now looked like just another overpriced hotel, charging more, offering less, and losing the trust of those who kept its doors open. The scars of Mandalay Bay's crisis run deeper than numbers on a balance sheet. In October 2019, MGM Resorts agreed to an $800 million legal settlement with the victims and families of the 2017 mass shooting. The payment, one of the largest in hospitality history, was supposed to bring closure. Instead, it became a permanent footnote in every news story, every Google search, every conversation among meeting planners. The shadow lingered. Internal surveys revealed that, even after security upgrades and public reassurances, many organizations quietly dropped Mandalay Bay from their shortlists. Planners cited sensitivity to attendee concerns and brand risk in confidential feedback, language that translated, in practice, to millions in lost bookings. The reputational wounds were not just about the past. In 2023, a guest's request for a simple toothbrush spiraled into a viral embarrassment after the front desk refused unless the guest paid a service fee. The story exploded across social media, drawing tens of thousands of angry comments and a wave of negative press. For a property that once prided itself on over-the-top service, the incident was a gut punch. Alyssa M., a former front desk supervisor, remembers the fallout. When they cut the concierge desk at Mandalay Bay, we lost a key part of what guests expected from a luxury property. It killed our repeat business. You could feel the frustration from guests, especially regulars. They would ask, "Why are we paying more for less service?" A lot of loyal customers just stopped coming back after that. Convention business, the lifeblood of Mandalay Bay's sprawling footprint, suffered most. Michael Chen, a senior planner for a National Engineering Association, describes the tipping point. His association dropped Mandalay Bay for their 2025 annual meeting after resort fees were jacked up and group perks they had received for years were cut. He had to explain to his board why attendees would pay more for a worse experience. They moved to a competitor across the street, and a dozen other planners told him the same thing happened to them. The broader industry took notice. Trade journals and hospitality experts chronicled a steady exodus of group business, citing Mandalay Bay's damaged reputation as a warning for the entire strip. Lost contracts and cancellations rippled through the property's ledgers, with every abandoned event translating into empty rooms and silent ballrooms. The brand, once shorthand for Vegas luxury, now carried a stigma that no amount of marketing could erase. The cost of that lost trust, measured in canceled conventions and vanished loyalty, proved far greater than any single settlement or viral complaint. A $2.3 billion loss is putting Vegas's Mandalay Bay out of business. And what's killing this iconic resort reveals a terrifying truth about how the entire Las Vegas Strip is quietly dying. Inside Mandalay Bay's financial records, the damage becomes undeniable. Over 8 years, the resort absorbed a sequence of blows that together explain the $2.3 billion collapse. The most glaring hit comes from asset impairments. $200 million written off as the property's value slid below what MGM once projected. These impairments reflect not just market softness, but a recognition that the billions spent on renovations and upgrades will never be fully recovered. The operational side offers no relief. From 2017 through 2025, Mandalay Bay's operating losses totaled $400 million. Each quarter, the resort struggled to cover payroll, utilities, and daily expenses as revenue from rooms, gaming, and conventions fell short. Even as management cut staff and scaled back amenities, the basic costs of running a mega resort barely budged. The numbers show a property running at a loss for years, with no sign of a turnaround. Debt service added another layer of pressure. Mandalay Bay's share of MGM's corporate debt translated to $200 million in interest payments over the same period. These fixed obligations could not be deferred or skipped. Even as guest numbers dwindled and income shrank, the resort had to keep paying its lenders on time, every month, without fail. Combined, the impairments, operating losses, and debt service drained $800 million from Mandalay Bay's books. This steady outflow of cash, set against falling revenue and a battered reputation, left the property with little room to breathe. The balance sheet tells a story of relentless financial bleed, where every attempt to recover, through cost cuts, new fees, or service reductions, only seemed to widen the gap between what the resort owed and what it could earn. The next question is simple. How much is Mandalay Bay actually worth now, and can it ever recover what has been lost? Bond traders and credit analysts began circling Mandalay Bay's debt, running worst-case models as the property's numbers grew more dire. On paper, the resort's net book value hovered around $1.1 billion by late 2025, but in the real world, no one expected a sale to fetch even that. After years of losses, asset impairments, and relentless negative press, the market consensus settled closer to $1.8 billion, roughly a 30% discount compared to recent strip deals. The reason was clear. Mandalay Bay's balance sheet was loaded with sunk costs and future risk. Insurance, once a safety net, now offered little comfort. After the 2017 shooting, MGM's insurance payouts and legal recoveries fell short of covering mounting premiums and deductibles. Over 8 years, the net insurance impact added up to a $100 million drag. Money gone, with no prospect of recovery. Every new quarter brought revised estimates from actuaries and underwriters, each one chipping away at Mandalay Bay's already diminished value. Inside boardrooms, restructuring scenarios became the main topic of discussion. A bond analyst speaking on background described the mood. We are pricing in a fire sale or Chapter 11. The only question is how much MGM can salvage. The most likely play was a sale-leaseback. MGM would sell the property to a real estate investment trust and lease it back to keep the doors open, hoping to shed debt without giving up the brand. But if cash flow kept sinking, bankruptcy loomed. In that scenario, creditors would seize control, unprofitable segments could be shuttered, and the property's future would hang in the balance. On Wall Street, Mandalay Bay's bonds traded at distressed levels, reflecting a market that expected drastic moves. Recovery rates were modeled at 40% or less. For investors, the underlying message was ruthless. The days of treating Mandalay Bay as a blue-chip asset were over. Its fate now depended on decisions made in closed-door meetings, where every scenario from asset sales to court-ordered restructuring was on the table, but no outcome was guaranteed. Today, Mandalay Bay stands as a warning. When loyalty is traded for short-term profit, even giants can fall. Across the Strip, guest satisfaction scores have dropped over 20% since 2019, and billions ride on whether Vegas can restore trust. The future of America's gambling capital now depends on remembering what made it irresistible in the first place. What do you think? Can Vegas recover? Or is this just the beginning?